Is Opendoor actually one of the biggest untold stories in the US housing market recovery? It's easy to miss what's really happening beneath the surface with open stock. Traders talk about it like it's a busted meme, or a short squeeze play at best. But what if there's a bigger story unfolding, one that has less to do with hype and more to do with fundamentals quietly shifting in Opendoor's favor? In this video, I want to make the case that Opendoor may be a hidden winner of the early real estate rebound. Not because they've suddenly become a flawless company, but because the external conditions that crushed them in 2022 and 2023 are starting to reverse. And they've survived just long enough to potentially benefit. Let's start by zooming out to look at the broader housing market. After a brutal stretch of rising interest rates and collapsing affordability, we're starting to see the signs of stabilization. Mortgage rates aren't plunging, but they've stopped relentlessly climbing. In some markets, they've even ticked down slightly. That may not sound like much, but in housing, perception often matters more than raw numbers. When buyers think rates are peaking, they start looking again. And that's exactly what's happening. Inventory remains tight, which helps support home prices. And when prices stabilize, or begin climbing even slightly, it changes consumer psychology. People who were sitting on the sidelines during the rate hikes are now stepping back in. They're thinking, maybe this is the low. Maybe it's time to move. That shift in momentum is incredibly important for a company like Opendoor. Why? Because Opendoor isn't trying to profit from a real estate boom. They make money on spread and speed. In simple terms, they buy homes at a discount, sell them for a premium, and try to do it quickly and efficiently. That model doesn't work in a frozen market where prices are falling and buyers are nowhere to be found. But in a recovering or stable market, that's where Opendoor can thrive. Now, let's talk about the company itself. Opendoor had a rough ride in 2022 and 2023. They expanded too aggressively, overpaid for homes during the boom, and were left holding the bag when rates spiked. Inventory losses piled up. Margins collapsed. The stock dropped like a rock. But instead of folding, they adapted. They cut costs. They focused on their best-performing markets. They improved their pricing models and tightened operational control. In short, they became leaner, smarter, and more focused. That doesn't mean they're now bulletproof. But it does mean they're better positioned to benefit from any macro tailwinds than they were a year ago. And those tailwinds may be arriving. In recent weeks, we've seen upticks in buyer activity across several metro markets: Phoenix, Dallas, Atlanta, places where Opendoor is deeply embedded. If that activity translates into faster turnover and better margins, earning surprises could follow. Now here's the thing Wall Street often misses with stocks like Open. The company doesn't need to be wildly profitable to see its stock re-rate. It just needs to beat expectations. If they lose less money than projected, or guide even slightly higher in Q4, that's enough to create upward pressure. Especially in a stock like this, where short interest remains elevated and many large holders are still in the red. Let's not forget, Opendoor recently regained compliance with Nasdaq and the board cancelled the reverse split vote altogether. That's not just administrative, it's strategic. It suggests the company believes it can sustain or grow the current share price without having to artificially boost it. That kind of internal confidence tends to precede something. Maybe it's improving financials. Maybe it's stronger than expected volume in Q3. Maybe it's a new product or service expansion. But it tells us this team is not operating from a place of desperation. They see a path forward, and they're choosing to walk it without financial engineering. Now, some investors might still be skeptical. And understandably so. Opendoor has burned a lot of goodwill. They've made mistakes, and the market has punished them. But that's the thing, the punishment is already priced in. The question now is whether they can rebound faster than the market expects. And there are reasons to believe they can. Let's talk about consumer behavior for a moment. Today's home buyers, especially millennials, are increasingly open to digital solutions. They're used to seamless, app-based experiences. They don't want to chase agents, attend 10 open homes, or wait weeks for offers to process. Opendoor's model, if refined correctly, is a perfect match for that demographic. Fast, clean, and tech-enabled. Now layer in the fact that Opendoor has started rolling out mortgage services, title offerings, and even cash-backed buyer solutions. They're not just flipping homes anymore, they're quietly building a vertically integrated real estate ecosystem. Think Amazon, but for buying and selling your house. That's a powerful long-term vision. And if the broader market gives them enough breathing room, thanks to this rebound, they might finally start realizing it. Let's also touch briefly on the sentiment side of things. Opendoor is once again trending across Reddit, StockTwits, and retail-heavy forums. It's still seen by some as a potential short squeeze candidate. Now, you don't need to invest for that reason, but it does mean there's built-in demand and volume potential if earnings surprise to the upside. If the company shows signs of life in Q3 and issues strong Q4 guidance, the stock could rally fast. It's a classic sentiment plus fundamentals setup. When both align, moves can be explosive. So where does that leave us? Opendoor is not without risk. The model still depends heavily on execution, market timing, and consumer demand. But the macro landscape is shifting, and they've put in the hard work to survive the downturn. In a recovering housing market, Opendoor doesn't have to dominate. They just have to participate, efficiently. If they do that, their earnings trajectory could look very different in 2025 than it did in 2023. And that could push the stock out of penny territory and into serious revaluation. Here's the takeaway. Opendoor is no longer just a meme stock story or a reverse split candidate. It's a real business in a stabilizing sector, led by people who've made painful adjustments and are now positioning for growth. If the rebound in real estate continues, and all signs point to at least a modest one, Opendoor could quietly become one of the biggest recovery plays on the market. The stock's already moved from $1.40 to over $2.10 in just weeks. But if Q3 earnings show momentum and housing data keeps improving, we could see a move to $3 or more before year-end. So ask yourself this: is the market still treating Opendoor like it's 2023, while the housing market and the company are already operating in 2025? Because if so, this might be the most underappreciated rebound play in the entire sector. Thanks for watching. Be sure to like, subscribe, and drop a comment below. Do you believe Opendoor is back on track, or is this just another head fake? I'll see you in the next video.